Something is happening in the silver market right now that most investors are completely missing, and by the time it becomes mainstream news, it's probably going to be too late to act on it. Silver demand is not just rising, it's exploding, and the supply side of this equation is struggling to keep up in ways that should be making headlines every single day. But it's not, and that silence, that disconnect between what's actually happening and what the financial media is talking about, is exactly where the opportunity lives. Let's break this down from the ground up. Silver has always had a dual identity. It's a monetary metal, a store of value, a hedge against inflation and currency debasement, but it's also an industrial commodity. And that industrial side is where the real story is building right now. The green energy transition is not a trend anymore. It's a structural shift backed by trillions of dollars in government spending, corporate investment, and global policy mandates. And at the center of that shift is silver. Every single solar panel that gets installed requires silver. There's no substitute. There's no alternative material that performs at the same level at an economical cost. Silver is embedded in photovoltaic cells because of its unmatched electrical conductivity. And solar deployment globally is not slowing down. It's accelerating at a pace that was not fully priced into silver supply models even 3 years ago. Think about what that means structurally. You have demand from the solar sector compounding year over year. You have EV manufacturers consuming silver in power electronics and charging infrastructure. You have the defense and aerospace sectors consuming silver in advanced electronics. You have the medical industry, the semiconductor industry, 5G infrastructure build-out. All of these are not cyclical. They are secular demand drivers that don't turn off when the economy softens. And then you layer on top of that the investment demand, the monetary demand, and suddenly you're looking at a supply-demand imbalance that is not a short-term blip. It's a multi-year structural deficit. Now let's talk about supply, because this is where the story gets really uncomfortable if you're not positioned. Silver is not primarily mined as a standalone product. Roughly 70 to 75% of silver supply comes as a byproduct of mining other metals: copper, lead, zinc, gold. That means silver production is largely a function of what's happening in those base metal markets. If copper miners slow down, if zinc production gets disrupted, silver output gets hit as a consequence, not because anyone is targeting silver supply specifically, but because of how the mining economics work. And right now, primary silver mining faces its own set of challenges. Grades are declining at existing mines, meaning you have to move more rock to get the same amount of silver. That raises costs. It raises energy consumption. It creates permitting pressure and environmental scrutiny. New large-scale silver discoveries are rare, and even when they happen, the timeline from discovery to production is typically 7 to 15 years. That is not a fast solution to a supply gap that is already opening up today. Add to that the geopolitical dimension. Mexico is one of the largest silver-producing countries in the world, and the political risk in Mexican mining operations has been escalating. Peru is another major producer that has seen significant social unrest affecting output. These are not minor footnotes. They are real constraints on the global supply picture that compound the structural deficit. The Silver Institute, which tracks global supply and demand, has confirmed consecutive years of market deficits. The numbers are not speculative. They are documented. Above-ground silver inventories at the major exchanges have been drawing down. COMEX silver stocks, London vaulted silver, both have seen meaningful declines from their peaks. And when inventories fall, that's the physical market telling you something that the paper market hasn't priced in yet. This is where smart money behavior becomes incredibly important to understand. Institutional investors who follow commodity cycles know that silver has historically lagged gold in terms of price movement in the early stages of a precious metals bull market, and then it dramatically outperforms, sometimes by a ratio of 3 to 1 or 4 to 1 in terms of percentage gains. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically elevated for an extended period. And historically, when that ratio compresses, it compresses fast, meaning silver prices can move violently to the upside in a very compressed time frame. Smart money knows this, which is why you're seeing increasing institutional interest in silver, not just through paper futures, but through physical delivery, through silver ETFs with physical backing, through royalty and streaming companies that have silver exposure, through direct stakes in primary silver miners. These are patient capital plays. They're being positioned now, before the broader retail investor community figures out what's happening. The Federal Reserve dimension matters here too, and this is something a lot of silver analysts overlook. We are in a period of profound monetary uncertainty. The Fed has engineered one of the most aggressive rate hiking cycles in modern history, and the consequences of that are still working their way through the financial system. Credit stress is building in commercial real estate. Regional banks are still under pressure. Consumer credit delinquencies are rising. The lag effects of monetary tightening are real, and they haven't fully hit yet. When the Fed eventually pivots, whether that's driven by a recession, a financial accident, or just the political reality of an economy that can't sustain these rates, the monetary tailwind for silver is going to be significant, because silver doesn't just benefit from lower rates abstractly, it benefits from the combination of lower rates and an industrial demand story that keeps running regardless of what the Fed does. That's a powerful combination. And then there's the dollar. The US dollar has been remarkably resilient given the fiscal situation of the United States, but the trajectory of US debt and deficits is not sustainable at any serious analytical level. The debt to GDP ratio is moving higher. Interest costs on the national debt are now consuming a growing share of federal revenue. Foreign holders of US treasuries are quietly diversifying. Central banks globally have been buying gold at record levels, and when central banks move like that, they are telling you something about their long-term confidence in fiat currency systems. Silver sits directly in the path of that concern. Now let's be honest about the other side of this. Silver is volatile, more volatile than gold. It can experience sharp pullbacks that shake out weak hands. If a true global recession hits hard, industrial demand could soften in the short term even as monetary demand strengthens. That creates a tug of war that can suppress silver prices temporarily even when the long-term story is compelling. Leverage in the futures market means that paper silver can get hit hard even when physical silver is tight. We've seen that pattern before. The paper market and the physical market can diverge in ways that are frustrating and counterintuitive in the short run. And mining stocks, which theoretically offer leveraged exposure to silver prices, come with their own operational risks: cost inflation, jurisdictional risk, management execution, dilution. These are real risks that investors need to price in when they're looking at miners as a way to play the silver thesis. But here's the thing about structural imbalances. They don't care about short-term noise. They resolve, eventually, always. And when supply cannot keep pace with demand over a sustained period, prices adjust. Sometimes gradually, sometimes suddenly. And the investors who understood the setup before the adjustment, those are the ones who look like geniuses after the fact. The solar industry alone is on pace to consume silver at levels that will strain annual mine supply within this decade. That's not a forecast from a silver bug on a forum somewhere. That's the output of industrial demand modeling based on actual installation targets that governments have already committed to. The International Energy Agency, industry analysts, mining consultancies, they all see the same demand trajectory, and none of them have a credible answer for where the additional supply is going to come from at current price levels. That last point is critical. At current price levels, the economics do not support the massive investment in new silver mining capacity that would be needed to close the supply gap. The market is going to have to offer a significantly higher price to incentivize that capital investment, and even then, you're looking at a decade-long lag before new supply comes online. So what you have is a market where demand is structurally increasing, supply is structurally constrained, inventories are declining, monetary conditions are likely to become more favorable, and the price hasn't fully reflected any of it yet. That's the setup. That's what the data is showing. And the question every investor needs to ask themselves right now is not whether silver has a compelling story. The question is whether they want to be positioned before the market prices it in, or after. The signal is there. It's been building quietly while everyone was focused on AI stocks and crypto headlines. But the physical silver market doesn't care about narratives. It operates on supply and demand. And right now, supply and demand are telling a very clear story. The ones paying attention will be ready.